Hello, how's it going? All right, so let's get back to it. We were about to look at the rest of chapter 14b. And let's see. Let's get that out of here. Let's get this out of here. I'm just cleaning up my desktop a little bit here. I have a lot of stuff open, as I always do. And so let's see, what were we doing? Oh, the asset market approach. All right. So this is what we're actually working on, this model right here. The asset market approach to exchange rate determination. Basically what it's suggesting is that the equilibrium exchange rate between two countries ultimately comes down to the interest rates in the two countries, as well as the current spot exchange rate and the expected value in the future. So this is the model we'll be looking at throughout the rest of the chapter. What it's saying here is that if you were able to hold funds in euro dollars or sterling, then what it's saying here is that the return to holding dollars, which means the earning, the euro dollar interest rate from an American's perspective. Hold on, let me clean this up a little bit. This is the return to holding dollars. And that's specifically, as we saw earlier, this is really the euro rate, the euro dollar rate. Now, on the right-hand side, this is the return to holding pounds. Sorry, the whole thing is the return to holding pounds. Because we're Americans, we don't know exactly what the return will be in dollar terms. We know what it will be in pound terms, but the change in the exchange rate here will influence the amount of return we get from holding pounds. So because this is an unknown quantity to us, we actually will call this not the return, but the expected return. Okay, so we're comparing the actual known return to holding dollars to the expected return to holding pounds, which is, as you can see here, EE, if you recall, is the expected exchange rate in the future. The actual E is the current exchange rate. In other words, this is something we observe today. So we can think of this as the actual exchange rate. But with the little e, that makes it an expected exchange rate. And now, of course, we don't know for a fact that this is what the exchange rate will actually be in the future. But a lot of our investment decisions have to be made on what we think will be true in the future anyway. When you think about it, if you buy stocks, why do you do that? Because you think the stock price will go up in the future. You can't possibly know that for a fact, but your investment decisions will be based on your expectations. So the same thing is basically happening here. We've got, when we hold a foreign currency, there's an exchange rate component that will affect the return to that particular currency. So what we're also going to say in this model is that the equilibrium exchange rate, E, which is what we're trying to determine, is the one that equalizes the returns to the two currencies. That's what we're aiming for. So in other words, you know that equilibrium, if you might recall, let me just do a little detour here for a second. What does equilibrium generally mean? Hold on one second. There it is. All right. So you might recall that equilibrium can mean a lot of things, but in finance and economics, equilibrium implies that there's a balance of some kind between two variables. And so you've seen this probably before with our traditional supply and demand curves for a single good. We have an upward sloping supply curve and we have a downward sloping demand curve. Equilibrium means we are at a point where the quantity supplied of this good equals the quantity demanded. That means the amount that's being produced is exactly how much people are willing and able to buy with that price. So we'll call this, let's say, P1 and E1, or Q1 rather, and this is just 1. This is our equilibrium point. So in equilibrium, there's a balance of some kind. Here it happens to be the balance between the quantity supplied of this good and the quantity demanded. If we're not in equilibrium, that means, let's say we're up here somewhere, the price is too high to be in equilibrium. That means there's an imbalance between the quantity supplied and the quantity demanded. Specifically up here, the quantity supplied is greater than the quantity demanded, and this is known as a surplus. And the net effect here will be that the price will drop until we find ourselves back in equilibrium. Now down here, if the price is too low, let's say at P3, the opposite is true. The quantity demanded exceeds the quantity supplied, and this is referred to as a shortage. And the impact of this is that the price will rise again until we find ourselves back in equilibrium. So this model is actually not very different than what we're seeing here. You'll see when we start drawing pictures of it in a minute that we have two curves crossing. At the point where they cross, we're going to find ourselves in equilibrium. If we're in any other position in the curve or the graph, we will not be in equilibrium, and there will be an automatic tendency for our exchange rate to change until we find ourselves in equilibrium. So here we're thinking in terms of not of goods and services, but financial assets. Specifically, think about this in terms of keeping your funds either in the domestic market or in the foreign market. So if we think about the euro currency market, an American investor could hold euro dollars, he could hold euro sterling, euro yen, euro, you name it. It's out there, and it's easy, in fact, to switch around between these different euro currency deposits. So we're assuming that this is exactly what's going on in the market, and that investors are very sensitive to changes in interest rates, as well as expectations. Okay, so, all right, so why don't we put all this together and come up with a graph that helps us explain what's going on in these currency markets. So we already have seen that our dollar is the known return to a U.S. investor from holding dollar deposits. This piece, the entire piece, all of it, is the expected return who's holding pound deposits. And again, when we say return, though, we have to be very clear here. Expected return in pounds, in dollars to a U.S. investor. Return in pounds is just this term right here. This whole thing now gives us the expected return in dollars. And if these are not equal to each other, what's going to happen? Just in general, let me explain that without the graphs just yet. So if the return to holding dollars is less than the expected return to holding pounds, we'd expect to see a reaction by investors. What will happen is, at least some investors will switch their funds from dollars to pounds. Okay, of course, because they're looking out for the highest rate of return. And the impact of that will be that the dollar will depreciate. And of course, that means the pound will appreciate. So if investors really believe that they'll do better holding pounds, any dollar holdings that they have will be switched into pounds. Okay. Now, if we have the opposite situation, let's say that it's the other way around, we can probably imagine what's coming next. We'll say here that if the return to holding pounds is, or I should say the expected return to holding pounds is less than the expected return, the actual return to holding dollars, investors will do the opposite. Investors will switch their funds from pounds to dollars. And so, of course, as a result of that, the dollar will appreciate. And of course, that means that the pound will depreciate. All right. So this is the logic behind what we're about to look at. All right. So that also means, though, that only if the returns are equal. All right. So there's the third possibility. If the expected return to holding pounds equals the return to holding dollars, then the market is in equilibrium. And there will be no tendency for investors to shift funds between currencies. That's it. So in other words, everyone's happy. They're holding the right currencies, the ones that make them happy. And so the market is in equilibrium. All right. So let's look at some numerical examples. Okay. So we're assuming here that the UK rate is 4% per year, that is, and the US dollar rate is 2% per year. The spot exchange rate is currently $1.85 per pound. And we expect that in the future, the dollar will get stronger because we're expecting that it will only take $1.81.3 to buy a pound in the future. So in other words, we can say that the dollar, this means that the dollar is expected, but we don't know that for a fact, but the dollar is expected to appreciate against the pound. Now, again, we don't know if that's going to happen or not, but if investors believe that, that will influence their decisions as to which currency to hold. And that's the important detail. All right, now, from the US perspective, since the US rate of interest is 2%, that means that if we keep our funds in dollars, we'll earn 2%. It's just that simple. But what about the pound? Now, keep in mind, too, we're expecting a weaker pound in the future or a stronger dollar. So how much of a difference will there be in the future? Well, let's look at this term by itself. This expression is the expected percentage change All right, percentage change in the exchange rate. Whereas just EE by itself, this whole thing is the expected percentage change. Just plain old EE is the expected absolute change. In the exchange rate. Now here you can see by plugging those numbers, it's negative 0.02, which means that the expected depreciation of the pound is 2%. Now, how do we know that it's a depreciation? Because when E rises, the dollar depreciates and the pound appreciates. If E falls, it's the opposite. The dollar appreciates and the pound depreciates. So that means in this case, that means that this expression going down indicates a weaker pound. All right, so this ratio, if it's negative, we have a weaker pound that's expected to happen. So this is an expected depreciation of the pound. So now we're going to bring this all together and we're going to say, well, we know that this is the expected return to the pound. This piece we've already seen is minus 0.02. But we were told earlier that the UK rate was 4%. So when you combine these, we get 2%. So the expected return to the pound is the same as for the dollar. Okay, so we'll see that on the next page or the next slide. There we go. Okay, this is again the return to the US dollar. And this is the expected return to the pound. And since they're equal, whatever the value of E is, this implies that E is the equilibrium exchange rate. And therefore, there's no tendency for it to change. There's no reason for Americans to put their money in pounds. There's no reason for the Brits to put their money in dollars. Everybody's happy. So we say that investors are indifferent between the two currencies. Oh, by the way, I forgot to mention one more thing. Remember, we said that E is $1.85. So that means that $1.85 per pound is the equilibrium exchange rate. Okay, now let's consider what would have been the case if this was not the actual exchange rate. Suppose we're not in equilibrium. For example, what if E is actually higher than 185? What would be the reaction of the markets to that? All right, well, let's try 186 as our example. So this part hasn't changed. This is return of the dollar. This is, of course, the expected return to the pound. And if you plug in those numbers, you'll see that, whoops, this is the different part right here. This piece is higher, isn't it? Yes. So because of that, we're subtracting a larger number, and all of a sudden, the return to the pound is only 1.5%. Ooh, that's a problem because now we're not in equilibrium anymore, are we? All of a sudden, the dollar is now more attractive than the pound. So what do you expect people to do? Okay, here we go. Investors want to take advantage of that. So they're going to sell their pounds and buy dollars. Because in order to invest and earn the US rate of interest, they have to, of course, hold dollars. So they'll sell some, at least, of their holdings of pounds and put them in dollars to take advantage of the higher returns. Now, of course, when this happens, this means that the pound depreciates and the dollar appreciates. And that means 186 falls to 185. All right, so in other words, in the process of doing this, we're affecting the strengths of the two currencies. And so that means eventually, or fairly quickly in the foreign exchange markets, the exchange rate will drop back to its correct level, which is here. And this will happen pretty quickly because, like I said, these markets are massive. We're looking at trillions of dollars changing hands every day. So that even a small change in interest rates could cause this to happen almost immediately. So we won't expect this situation to persist for very long. Now, of course, we need to consider the opposite case, which is if he is too low. Well, I'm sure you can figure out what's going to happen. The opposite will happen.
I'll tell you to straighten this one up.
So as it says here, funds will flow out of the UK into the US, the dollar will strengthen, and again, eventually we'll reach equilibrium, which as we know is E equals $1.85. Now, how about the opposite situation? E is too low. Okay, and of course that means the dollar is too strong. So let's say that it's 184. If you plug in those numbers, hold on one second. So at 184, look what happens. Now this hasn't changed. This is the return to the dollar. That's not affected by any of this. But the return of the pound, if you notice, this fraction is actually a little bit smaller now. So when we subtract it, all of a sudden, the UK return is higher than the US return. And so all of a sudden, the pound is now more attractive. Than the dollar. And therefore, you can imagine what's going to happen. Investors will sell dollars, buy pounds. And so the result will be that the dollar depreciates. The pound appreciates. And as a result, E rises back to $1.85. All right. And so this is what we mean by equilibrium. If the exchange rate is not at equilibrium, it will adjust itself until it is. All right. So if the return of the dollar is below the UK, attracting in the UK or investing in the UK suddenly becomes more attractive than the US. And you know what's going to happen. Investors will switch their funds out of the US and into the UK. In other words, they'll sell dollars and buy pounds. Eventually, everything will be back in balance. Now, what I've done here is I've constructed a table for all these different possible values of E, and we're going to see exactly what happens. So we've already considered these two cases. Okay, so what's common to all of these is that everything above here means that the pound is more attractive than the dollar. Okay, let me do this real fast. I want to keep this all on one page if possible. Up here, the dollar the pound is more attractive. And so what's going to happen is the dollar will depreciate. I'm running out of space. I'll just write DEP down here. It's the other way around. The dollar is more attractive. And so the dollar will appreciate. I'll just write up APP or something. So in other words, there's a tendency, once we get out away from 185, if we're down in this range, the exchange rate will tend to drop. And when we're up here, when it's too low, there's a tendency for E to rise, so that we always end up right here again. Now, it turns out, though, that there's an easier way of analyzing this, and that involves a graph. So what we're going to want to do is graph the two returns so that we can visually see how this works. And when you see them, you'll realize that they remind you of supply and demand curves. All right, why don't we check this out? So this is the curve that represents the return to the pound, or expected return to the pound. And you can see all I did was copy the numbers off of this table. So for each value of E, 185, 4, and 6, I've copied the return in this last column. And you can see we have a downward sloping curve. Okay, now that makes sense because as E strengthens, now remember, going in this direction, E appreciates, the dollar appreciates. And so as the dollar appreciates, the return to the pound is actually increasing, and vice versa, of course. Now, here's the big question. What about the US return? Where would we put that in this graph? Well, keep in mind, the exchange rate is on the vertical axis. The return of the dollar is independent of the exchange rate. So therefore, it will be a vertical line. All right, so we're going to see that in the next slide. There it is, okay? So this one is vertical because it does not depend on E. It's 2% regardless of E. So we've got a vertical line and we've got a downward sloping line. And of course, they cross at exactly one place. And that place is our equilibrium. So according to this graph, the equilibrium exchange rate is $1.85 per pound. Because at this exchange rate, the returns to dollars and pounds are equal. And that's not true anyplace else. All right, now here's what I'd like to do. Let me copy this graph into the next slide, because I would like you to notice something. What I'd like you to notice is this. What if we're not in equilibrium? Okay, so up here, for example, at 186, the US rate is greater than the UK rate. So therefore, we've already seen that investors shift their funds into dollars, the dollar appreciates. And remember, because of the way it's quoted, a lower exchange rate actually means a stronger dollar. So we'll drop down until we find ourselves in equilibrium. Down here, it's the other way around. Okay, so when the exchange rate is only $1.84, the dollar return, which is right here, is less than the British return, which is here. And that causes the dollar to depreciate, or in other words, the exchange rate rises. Okay. And that means it goes up. So in other words, you can see that this market will automatically adjust if there's any change here. In other words, if we're not in equilibrium, there's an automatic tendency for it to return directly to the correct or equilibrium exchange rate. Let's call this E to remind ourselves that this is equilibrium. So we're going to assume that we're in equilibrium, but if we're not, there's an automatic tendency to adjust back to the correct equilibrium level. So again, it's kind of like a supply and demand curve, except that we have a vertical supply curve. Nothing else has really changed. Okay, we have the exchange rate on the vertical axis and the return on the horizontal axis. This is just a percentage. It applies to both currencies. All right, now here's the big question. Now, again, referring back to the supply and demand curves, we know that there are several factors that can cause the supply and demand curves to shift around. And when they do, that will change the equilibrium price and quantity. All right, so let me show you a few quick examples in case it's been a while since you had an economics class. For example, let's say we start here with our equilibrium position. And here's our supply curve, here's our demand curve. And then for some reason, the demand for this product increases. The entire demand curve shifts to the right. And we have a new equilibrium quantity and a new equilibrium price. Okay, so this is an increase in demand. And as a result, the price goes up and so does the quantity. You can tell from here, the price is higher now and the quantity is higher as well. Beautiful. Now you can probably guess what's coming next. What happens if there's a decrease in demand? And again, there could be a lot of reasons for this. It could be something as simple as incomes went up, or the taste for the good went up, or who knows. Now, for the decrease case, we just move everything in the opposite directions. So we have 1 and 2. And so here we've got a price of 1, P1, Q1. So you can see this time everything worked in reverse. For a decrease in demand, the price drops and so does the quantity. Okay, now we still have to consider what happens when there's a change in supply. All right, let's find out. The supply curve can shift as well as the demand curve. Let's see what happens in those two cases. We'll start with an increase in supply. Let's say here's our equilibrium point. So increase in supply is here. Okay, so you can see this one is a little different because all of a sudden we have a lower price, but we also have a higher quantity. Okay, so when the supply goes up, we get two good things going on here. We have a lower price and a higher quantity. That's exactly what makes us happy. All right, as consumers, this is our favorite situation because we get to have more of the product at a lower price. And then finally, we want to consider the case of a decrease in supply. So this, let's do it this way. We'll start here and end up here. So here's the price initially, the quantity, and then all of a sudden the price goes up. Oh, this is bad news, isn't it? You notice the price went up and the quantity went down. So those are the four possibilities when we're dealing with curves like this. So something similar will happen here with our equilibrium exchange rate model. There's actually three things that can change, and we have to understand how they affect these curves, which in turn we have to use to understand how they affect the equilibrium exchange rate. So again, what we're going to do is take a factor, change it, and see what impact it has on the curves and what impact that in turn has on the equilibrium exchange rate. All right, let's try this. All right, so starting, once again, let me just remind you what this thing looks like. And you'll get some practice with it too, I hope. On the vertical axis, we have the exchange rate, which is, in this case, dollars per pound. Here's the rate of return as a percentage. The US rate is fixed at whatever this is. And this curve is the return to the pound, but it incorporates this expectation term. And so where they cross, we have our equilibrium exchange rate. Let's call it 1E1. Now, what happens if one of these variables changes? Perfect example of this, what if US rates of interest change? It happens all the time. Should that affect the strength of the dollar? And if so, how? All right, we'll find out. By the way, I just want to remind you, based on those graphs you just saw, an increase in a variable means that curve shifts to the right. And of course, a decrease is a shift to the left. So keep that in mind when we're doing these. So with the dollars, an increase in the US rate of interest makes dollar deposits relatively more attractive than pound deposits. As we have already seen, funds flow out of the UK and into the US. the increased demand for dollars and reduced demand for pounds combine to give us a stronger dollar. So using our previous example, let's see how this works numerically, and then we'll see how it works graphically. So this is where we started out, if you recall, and you can see we're in equilibrium because these equal each other. All right, return to the dollar, and the expected return to the pound. All right, and all of a sudden they're not in equilibrium anymore because the US interest rate went up. So it makes the dollar more attractive to investors. And so as a result, we should expect to see a stronger dollar. But how much stronger? All right, so now all of a sudden, look what happened. We already know that the return to the pound is only 2%. The return of the dollar is 3%. And that means, of course, the dollar will appreciate because of the flow of funds out of pounds and into dollars. But how much? All right, let's find out. We know that investors will move their funds out of pounds and into dollars. The question is, what's the new equilibrium interest rate? Exchange rate, sorry. All right, well, algebraically, here we have to do something important here. We started out with our equilibrium equation. It's written this way so that it's obvious that what's on the right-hand side is expected return to the pound, and the left-hand side is the return of the dollar, and that's very nice. But as far as determining the equilibrium exchange rate, it's not that helpful. We need to rearrange it algebraically to solve for E. And when you do, and you can take my word for it, or you can prove it yourself, that this is the model that we'll use to determine the equilibrium exchange rate. So this is a ratio. Let me rewrite it like this. So this is what we're going to use to figure out the new equilibrium exchange rate. So once you've got to that point, it's really not that difficult. I mean, you just get your calculator out and figure out what the new equilibrium exchange rate must be. All right, so given the numbers that we have, so let's see, the only thing we changed was the US rate of interest. Everything else is the same. So in other words, remember, this is 1.813. This is what we expect to happen in the future. The UK rate was 4% initially. This is the new US rate equals 3%. So if you plug all those in, E is now 1.831 instead of $1.85. So that means, as we predicted, the dollar has appreciated because it takes fewer dollars to buy a pound. Okay. All right. So now we're going to see this graphically. And what's going to happen is the US dollar return curve, I guess you could call it, has shifted to the right because the US rate has jumped up from 2% to 3%. And where it crosses, the new equilibrium exchange rate is right here, 1.831, which implies a stronger dollar. All right, does that make sense to everyone? All right, I take that as a yes. All right, good. Now you can probably imagine what's coming next. What happens if the US rate goes down? Well, everything will just work in reverse, of course. So for example, What if the US rate drops from its original 2% down to 1%? What happens? Well, algebraically, you can see that the dollar is now less attractive than the pound. And so how will we react to that? Well, we know the story. The dollar is now less attractive than the pound. So investors shift their funds from dollars to pounds, of course. And therefore, we expect the pound will appreciate. And of course, the dollar will depreciate. The question is, to what level? All right, well, let's find out. Plug in the new numbers, and oh, there you go. This has been replaced. It was 2%, now it's 1%. And here we go. The new equilibrium exchange rate is 1.869, which means the dollar has gotten weaker. And as we expected, and of course on the graph, you'd expect that the dollar return curve has shifted to the left. And you'd be absolutely correct. So it just went the opposite direction. Okay, well, you know what? The dollar rate in the US, the interest rate in the US can change, but so can the pound rate. So what we want to consider next is what happens to the equilibrium exchange rate if the UK rate of interest changes. And here's a hint, this curve will be the one that changes now instead of this one. All right. By the way, I just want to show you something algebraically here before we go any further. This might help you keep track of what's going on here. Because the equilibrium exchange rate formula is all right, it's EE over 1 plus R dollar minus R pound. Algebraically, if EE rises, then so will the actual equilibrium exchange rate. If EE falls, so will this one. Okay, because this is in the numerator. But if the dollar interest rate goes up, because it's in the numerator, or the denominator rather, that means E has to go down. And similarly, if the US rate drops, E has to rise. And then finally, for the UK rate, which is where we're heading now, if you notice, while the UK rate is in the denominator, it is negative. So if you subtract a larger number, you're reducing the size of the denominator, which increases the entire ratio. Okay, so these two are going in opposite directions. All right, so just a hint as to where this is going. When we look at the changes in the UK rate, you should not be shocked to see how they affect the equilibrium exchange rate. And keep in mind too, when the UK rate goes up, that means that the pound is becoming more attractive than the dollar. That should, of course, make the dollar get weaker and the pound get stronger. All right, so let's look at our original data. And we're going to change this time the pound exchange or the pound interest rate. And let's raise it to 5. What the heck? So that means this hasn't changed, but this has. This first value has gone up. And so all of a sudden, if you notice, the dollar return is less than the UK return. And what does that do? Well, that means people will buy pounds and sell their dollar holdings. Which means that the dollar will depreciate. And of course, the pound appreciates. Well, let's find out how much though. And let's see how the graph looks when this happens. So I plug in all the new numbers. Now, the only thing that changes right here. So I subtracted a larger number. So the entire value goes up. And in fact, the exchange rate goes from 185 to 186.9, which means that the dollar, as we predicted, has depreciated. Now, in order for this to make sense graphically, the only way this can happen is if this return to the pound curve is shifted to the right, okay? So in other words, these haven't changed. This one has. So the entire curve shifts to the right with no change in the US dollar return. The curve shifts to the right, and at our new equilibrium point, as we predicted, we have a weaker dollar. Just like we predicted. So it's always nice when these graphs work out just right. So a higher UK rate leads to a weaker US dollar. Well, you can probably guess what's coming next. We're going to now lower the UK rate. And obviously everything will work backwards. Okay, backwards. So let's see this happening now. So let's say, now remember, originally the UK rate was 4%. Let's drop it down to 3. So all of a sudden, look what happens on the right-hand side of this equation. The UK return is only 1%. The dollar is now, return is more attractive than the UK rate. So therefore, people sell their pounds, buy dollars. And as a result, the dollar appreciates. Yes, it does. And then on the curve, we see that algebraically, this brings the exchange rate from 185 all the way down to 183.1 after a fall in interest rates. So as a result, you can imagine that the curve that we were just looking at has shifted to the left. All right, to the left this time. So now the new equilibrium exchange rate is here. And so the dollar, as we predicted, has appreciated. And of course, that implies that the pound has depreciated. All right, so what I'd like to do is summarize this real fast. Based on everything we've seen, what we can conclude from all this is that if a country's interest rates rise, its currency will appreciate. If a country's interest rates fall, its currency will depreciate. Now, of course, it's understood, I'll put this in parentheses, holding everything else constant, of course. But in general, that's the rule of thumb. Higher interest rates means a stronger currency. And again, it's because it becomes more attractive to investors. All right, the last thing we want to consider is expectations. That little EE term. So remember, we have to be careful with this one. Because E is dollars per pound, if EE rises, investors expect a weaker dollar in the future. Okay, at least compared to previously. And then if EE drops, again, because of the way it's defined, investors expect a stronger dollar in the future. Just keep that in mind so that what follows will hopefully make sense. Now, what causes this to happen? Why do investors change their expectations? Well, that's a very good question. There are so many factors. Many factors can cause investors to revise their expectations about the future value of a currency. For example, all right, so what I'd like to do is put together a quick list of some factors. These factors can cause investors to become more optimistic about the dollar, let's say the dollar. Falling inflation, rising interest rates, faster economic growth, falling, let's say, international tensions, that kind of thing. In other words, it doesn't have to all be economic factors, not purely economic factors. Oops. What about, well then, obviously the opposite would be true. I mean, every little thing. I could have put a dozen factors there. So here, we'll just reverse all these. What can cause everyone to become more pessimistic about the dollar? Rising inflation, falling interest rates, slower economic growth, and rising international tensions. So, in other words, this can happen very quickly and very suddenly. People can become optimistic. It's just like if you watch the stock market at all, it'll be booming along, and then one day, all of a sudden, it loses 500 points for no reason, and then it might happen for a couple of days, and all of a sudden, it's right back to normal again. So, it's like, what's going on here? Why are people switching they're changing their views so quickly? Well, new information comes along, and before you know it, they change their minds, and expectations can change very, very quickly, certainly much more quickly than interest rates. So a lot of the volatility in interest rates, exchange rates rather, is driven by changes in expectations rather than interest rates, which, they don't change that quickly over time. Certainly not fast enough to explain why exchange rates bounce around so much. Anyway, so let's go back to our original example. We're going to finish up this, this model. What we're going to do this time is change the expectation. All right. So suppose that all of a sudden the US economy weakens, our prospects get weaker, we become more pessimistic, and we update our opinion about where the dollar's headed from $1.81.3 per pound up to 183. What's going to happen to the dollar? All right, well, let's plug in the new value of EE, I should say. And you'll notice that it had previously been 1813. So since EE rises, E also rises. They both go in the same direction. And that implies a weaker dollar. So how do we show this on the graph? Oh, look at this. Just like with the UK interest rate, this number has increased. The entire curve shifts to the right. And before you know it, we have a weaker dollar. Now, this is the interesting part. Investors began to expect a weaker dollar. And so guess what happened? The dollar depreciated. In fact, sometimes you hear things like that called a self-fulfilling prophecy. All right. In other words, because we expected a weaker dollar, it got weaker. Okay. Why is that? Because when we expected to weaken, investors are going to sell their dollars. So in other words, when E rises, investors sell dollars and buy pounds. And this is exactly why this is happening. So we expect a weaker dollar, but that by itself isn't enough to change anything. But because that leads us to sell dollars and buy pounds, all of a sudden, before you know it, the dollar does start to weaken. There you go. All right. Now, I'm sure you know what's coming next. We have to figure out the case when we become more optimistic about the dollar. Something's happening. The markets are booming. All right. So instead of 1.813, it suddenly becomes 1.800, which means more optimistic. And so let's see what happens. We plug in the new numbers here, and there you go. So the equilibrium exchange rate is dropped from 185 to 183.7. The dollar has gotten stronger just because people expected it to. All right, so people became more optimistic about the dollar. And so what they did was they bought dollars, they sold pounds, and before you know it, the dollar appreciates. It's just that simple. And the curve shifts to the left. So that covers all the possibilities for this graphical framework. We've got three factors that could change. We've got the US rate of interest, the UK rate of interest, and the expected future exchange rate. If any of them changes, the entire relationship between the exchange rates will change. And so therefore, we'll find ourselves with a new position with the curves and a new equilibrium exchange rate. Now, keep in mind, this whole model is based on the assumption that investors view currencies as simply another type of financial asset. The only thing they're thinking about is which ones give me the highest rate of return. And that's it. That's the only thing we care about. And so in a case like that, you can probably easily imagine that this kind of behavior will actually take place. All right, now that I believe is the end of chapter 14b. So that was a very long chapter, as you know. We're going to need these graphs throughout the rest of the course. So it was important to spend time setting all of this stuff up so that we could understand what follows. So it's important to be able to calculate the new equilibrium exchange rates and also to show all of this graphically. All right, graphically too, because it helps a lot to understand. And some of the later graphs in the later chapters also take this as a starting point and they add more details to it. So it's important to really understand what's going on here. All right, so hold on one second. Let me save this. Today's the 4th. And now, of course, obviously what's following this is chapter 15, but the question is what's hiding in this mysterious chapter 15? Okay, it's a little bit different because in chapter 15, what we're really looking at is monetary policy. Now, in order to understand monetary policy, I guess we could probably take a bit of a detour. You know what? Let me do this. I've got some nice notes from another class that introduced the Federal Reserve System. Let's just go back. Let me go grab them. Because all of this comes down to the Fed. Everybody's heard of the Fed, but you may not know exactly what it is and how it works. All right, so let me go get this real fast. Just a quick overview. Just to give you a sense of what the Fed is all about. Oh, sorry, no, wrong one. I mean, not that it's not wrong. I just wanted you to get a look at the structure of the Federal Reserve System before we dive into this. Then we'll start talking about monetary policy. So in this chapter, this is from a macroeconomics class. We start by talking about money, which we will do that too. But let me jump ahead a little bit and show you more about the Fed itself. So here we go. Here's the Federal Reserve System. Now, the Federal Reserve System is the central bank of the United States. Every country has a central bank. It has several very important duties to carry out, which we'll see in a few minutes. But the Fed has an unusually interesting history compared to most other countries in the world. Because it was created so recently in our history, but prior to the Fed, there were actually 2 earlier central banks in the United States. So you can see for yourselves, the first one was called the First Bank of the United States, and the second one was called the Second Bank of the United States. Now, in each case, Congress granted them a 20-year charter, just in case it didn't work out. The first one was actually the brainchild of Alexander. He thought it was important for the U.S. to have a central bank in order to help itself grow into what he hoped would become a world power. He was hoping to modernize the U.S. economy, which at the time was almost exclusively based on agriculture. And so he recognized that we would need a modern banking system in order to fuel growth and move into the, at the time, the 19th century. So the first bank worked fairly well. I don't remember the exact reasons why the charter wasn't renewed. A lot of it was all about politics. It seemed to work pretty well. But there were a lot of people in Washington who did not appreciate having such a powerful central bank. I guess it sort of muscled into their territory, they felt. So the first one was not renewed. And so for about 5 years, there was no second central bank. And then we got a new one in 1816, the Second Bank of the United States, another 20-year charter. So this time, now, this was a different situation. When the charter ended in 1836, President Andrew Jackson was vehemently opposed to renewing the charter because he was feeling that the banks were too powerful, that they were taking advantage of the little people, because he was actually himself from the backwoods of Tennessee, and he kind of had a distrust for Eastern bankers, Northeastern bankers, I should say. So he made sure that it was not renewed. And then we had no central bank until the Fed came along in 1913. So you can imagine the US economy was pretty chaotic during those days. So the Fed, when it finally came into being in 1913, was intended to be a system of central banks, which helps explain why it's structured the way it is. So what is the Fed set up to do? Well, it has a lot of duties. It regulates the banking system. It acts as a lender of last resort. If banks are in trouble, they can go to the Fed and get loans. It issues currency. All the paper money in your wallet was issued by the Federal Reserve System through your local banks. It wasn't printed by the Fed. That takes place at the Bureau of Engraving and Printing in Washington, but it was issued by the central bank the Federal Reserve Bank in your district, and then it works its way through the banking system. And finally, the one that we're focused on in this course is its conduct of what we call monetary policy. All right, now the Fed is broken up into 12 district banks, and this is the map of those 12 banks. Now, what's interesting about this map is that if you notice, almost all of the Feds are sort of in this northeast and sort of somewhat towards the center of the country, but very few are out here on the West Coast. Now, what do you suppose that is? Because this reflects the population of 1913. The goal was to have each district represent roughly the same number of people. And in 1913, that's exactly what it did. Okay, that was way before people started moving to California in droves. And so there's only one Federal Reserve Bank on the West Coast. That is the San Francisco Fed. So the borders are like, look at the Minneapolis district. It's enormous, Kansas City even, because hardly anyone lived west of the Mississippi at that point in time. In fact, the San Francisco Fed also includes Alaska and Hawaii in its district. The Virgin Islands, I think they belong to the New York Fed, but I'm not positive. I have to double check that. So there's 12 of them, and every dollar bill in your pocket tells you which Federal Reserve Bank issued your dollar bill. It says it on the front. There's a big seal there with a letter, and that tells you which Federal Reserve Bank issued your dollar bill. So anyway, the Board of Governors, which you may have heard about in the media, actually runs the whole system. They're located in Washington. It contains, the board has 7 members. There's a chairman, who's currently Jerome Powell, and there's a vice chairman, whose name I do not know. And by the way, just by an interesting coincidence, the Fed is actually meeting right now as we speak. Let's just see. Yesterday and today, what happened there? No, wait a minute. I thought, hold on. Oh, okay. Here we go. Why inflation is kryptonite for bonds as Powell's comments rock the markets. So Jerome Powell is the chairman of the Fed. He expressed little worry about inflation and provided no indication of policy changes ahead. So why is everybody freaking out? Oh, because Powell must have said that inflation is set to increase, but it'll only be on a temporary basis. Wow. And that's all it took for the markets. I was saying this before, the markets will go up and up and up, and all of a sudden they start to crash. And wow. So yeah, well, hold on a second. They usually show you how, yeah, here we are. Yeah, it looks like the Dow had a rough day today. The S&P 500, the NASDAQ. But you know what? You wait a couple of days and they'll be right back to booming. But yes, the Federal Reserve System did announce. I guess people are worried that that means they might think about raising rates in the future. And that is bad for the economy, or at least it makes it more expensive to borrow. And that makes it more difficult for businesses to expand and for people to buy houses and durable goods like cars and appliances and that type of thing. All right. Well, anyway, so Jerome Powell, whose picture you saw there, is the chairman of the Board of Governors. And so they are the ones who get together. Well, they oversee the whole system. Each governor gets a 14-year term from the president. The chairman and the vice president get 4-year terms. Now, the Board of Governors has a few duties. We'll discuss this later on, but the required reserve ratio tells us how much, what percentage of our deposits each bank is required to hold and not lend out to customers. And the discount rate, which is the rate at which the Fed lends to banks. They're the ones who also oversee the regulation of the banking system. But the important part of the Fed, from our perspective, is the Federal Open Market Committee. They're the ones who conduct monetary policy. In other words, they're the ones who decide whether to raise rates or to lower rates or just to leave them where they are. Okay, so they are the ones who have all the power as far as monetary policy goes. The FOMC consists of 12 members, all members of the governors, plus 5 Federal Reserve District Bank presidents, one of which is always the New York Fed president. Obviously, because New York is in the world's top financial district. So all 12 of them get together several times a year, and they decide what should we do about interest rates. Raise them, lower them, stay the same. Now, the thing is, if you notice, Powell basically said, we think there might be a little inflation coming, and that's all it took for the markets to tank. So they have to watch what they say, because the markets have a tendency to overreact to scary news. And so they've always got to keep, just don't go nuts, don't say too much, just indicate where you're going and then let it go at that, because you can see how the markets can react to that. Okay, so the Federal Open Market Committee sets what's called the federal funds rate target. That's the rate at which banks lend and borrow among themselves. That's when they say in the news that the Fed has raised rates or lowered rates, what they really mean is that the Fed has changed this target, the federal funds rate target, which means the level that they're trying to keep this rate at. They will carry out these open market operations, which means they're either buying or selling bonds from the banking system. And the purpose of that is to keep the federal funds rate target where it belongs. And then finally, they can also intervene, as we'll see later on in the course, in foreign exchange markets. They have the ability to prop up or weaken a currency by either buying or selling it. They don't do it very often, but they can if they need to. They meet 8 times a year. They announce what they've decided to do, and the market reacts accordingly. All right, so let me just quickly tell you what these two are all about, and then I think that'll be enough. We can go back to the slides that we have. Expansionary monetary policy means that the Fed lowers interest rates with a goal of expanding the economy. All right, so expansionary means expanding the size of the economy. The only way that's going to happen is if they lower interest rates, and that entails an expansion of what we're going to call the money supply. We'll discuss that in chapter 15. Well, then the opposite of expansionary is contractionary. And this means that we will slow down economic growth by raising rates in order to prevent inflation from getting out of hand. And that's what Jerome Powell was talking about today. He thinks that inflation might be heating up a little bit, which means they probably will start raising rates down the road a little ways. And that's why the markets were so nervous today, because they're worried that this is going to happen right away, or it'll be, let's just say it'll harm a lot of businesses if they start raising rates too soon, because they're still trying to recover, of course, from the COVID pandemic. All right, well, anyway, that's enough of that for now. We can now go back to our own slides and start covering chapter 15 properly. But before we do that, we're going to take our break right now, our usual late evening break. And when we get back, we'll discuss this monetary policy in more detail. But here are the focuses on how that affects exchange rates. That's really what the primary focus here is on this class. How does monetary policy affect exchange rates? All right, so I guess I'll see you all in a bit. And when we get back, we'll talk about monetary policy. Ah. All right, so let's get back to this. We're looking at monetary policy. So central banks can influence the strength of a currency indirectly through their control of monetary policy. So banks, now of course, the main goal of a central bank is to achieve sustainable growth that is consistent with a low and stable rate of inflation, if they can do it. It's hard to do. That's what they're trying to accomplish. They want the economy to grow at a steady rate, but not so fast that there will be an increase in inflation, and not so slow that there will be an increase in unemployment. This is their goal. This is what they're aiming for. They can't always achieve it, but this is what they're trying to do. Now, in the US, this is obviously the most important thing. The Federal Reserve System doesn't usually intervene in foreign exchange markets. Their attitude is that, let the exchange rate go where it wants to go. They will focus their attention on keeping inflation as stable as possible. But of course, every action they take ultimately does influence the strength of the dollar. So, as I've already started to discuss, expansionary monetary policy is used to stimulate the economy during a recession. And if inflation is in danger of getting out of control, they use what's called contractionary monetary policy to help reduce inflationary pressures. Now, how exactly does this work? Well, with expansionary monetary policy, they will increase the money supply, which we will define in a little while. That leads to lower interest rates. And of course, what that means is that businesses will invest more, consumers will spend more, and the economy will grow more quickly, which is a good thing. In the short run, unemployment falls, but if this keeps up, in the long run, we'll see a higher rate of inflation. And this is exactly what they're trying to avoid. All right, now, what about contractionary monetary policy? This is where everything works in reverse. They reduce the size of the money supply. As a result, interest rates start going up. That makes it more expensive for businesses to borrow and invest. It also makes it more expensive for consumers to buy goods like cars and houses and furniture and appliances. So the economy slows. And so unemployment, unfortunately, starts to rise, but it does have the effect of lowering inflation. Now, ultimately, and we're going to see in our graphs that are coming up, in the short run, right now, when prices are, there's not enough time for prices to adjust, interest rates are determined or assumed to be determined directly by the supply and demand for money. All right, so in the longer run, other factors come into play, but in the short run, when prices are stable, we're going to assume that interest rates come from the interaction between the supply and the demand for money. Okay, now the supply of money is assumed to come directly from the central bank. Now, the central bank doesn't directly control the supply of money, but they do control something called the monetary base, which we'll look at in a second. The monetary base, in turn, influences the size of the money supply. Now, it turns out that if you've ever had an accounting course of any kind, and I think you're required to take one here, you've seen financial statements which show, let's say, for example, the balance sheet of any corporation will have three important items on it. Let me just quickly show that to you. And so a typical balance sheet for a private corporation will look something like this. We'll have assets on the left. Over here, we have liabilities. Assets are, of course, the things of value that the corporation owns. Liabilities are the debts. And then down here, we have equity. And the key detail here is that assets equal the sum of the assets equals liabilities plus equity. And of course, this implies that equity is simply the difference between assets and liabilities. All right. So in other words, equity is what's left over. In other words, we have assets that have a value. If we subtract off the debts that we owe from that, what's left over is what we mean by equity. Now, hopefully this is positive, by the way. Now, something similar to this happens when you have, let's say, a house. When you own a house, you buy it, let's say you make a down payment and you make payments. What starts to happen is in small stages, you start to own a larger and larger percentage of the house, and the bank owns a progressively smaller percentage of the house. So the equity you've built up in your house equals the difference between the market price and how much you still owe the bank. So something similar is happening here. The equity in a corporation represents the difference between the assets that we've acquired and the liabilities that we incurred in order to acquire these assets. So the Federal Reserve also has a balance sheet, but because it is not a profit-making organization, they do not have any equity. It's just assets, liabilities. And of course, what constitutes an asset for the Fed is very different than what constitutes an asset for a corporation. And the same thing with liabilities. So we're going to take a very quick look at a simplified version of the central bank's balance sheet. Now, this is very, very simplified. I'll tell you right now. On the asset side, we have what we will call domestic assets, which means loans that were made to the banking system and any treasury securities that we may have bought over the years. The Federal Reserve does have its own funding, internal funding. They do not need funding from Congress. And if they have a surplus, they often use it to buy treasury securities. And sometimes they also buy foreign assets, which means typically securities issued by foreign governments. Okay, not for example, foreign stocks, but foreign government bonds, the very safe ones, in other words. So on the asset side, we have these domestic assets, which are loans to the banks and treasury securities issued by the U.S. Treasury Department. Over here, we also have foreign assets. Typically, these are bonds issued by foreign governments. All of these added up give us what we call the monetary base. On the right-hand side of this equation, we have the liabilities of the Fed. Now, interestingly enough, all the currency in circulation is considered to be a liability of the Fed. Now, when we were on the gold standard, of course, this really had some meaning, because if you held paper money in your wallet, you could bring it to a bank and demand to be paid in gold, and that gold had to come from the Fed. I mean, they were the ones who had to guarantee the gold in these notes. And so the bank reserves, now, this one is going to take a little explanation. Let me do a little detour here to explain what we mean by total bank reserves. So what is that all about? Banks are required by the Fed to hold a fixed percentage of its deposits in the form of reserves, which are deposits held at the Fed. This is done in order to preserve the safety of the banking system. In other words, they don't want the banks to lend out 100% of their deposits, because then you can end up with bank runs where people want their money back and the bank doesn't have it. So the banks are required by the Fed to hold a fixed percentage of its deposits in the form of reserves. These reserves earn very little interest to the banks. But these reserves also belong to the banking system, so that they're considered to be liabilities of the Fed. In other words, they have to give this money back if it's asked for. Okay, now, by the way, this brings up another important concept that I want to show to you relating to these reserves, because reserves pay very little interest. Banks typically try to hold only as many reserves as they're required to. Okay. In other words, if they're required, let's say a bank is required to hold $1 million worth of reserves, and the bank is going to try to hold exactly $1 million, and that's it, because anything beyond that, they're losing interest. So because of this, though, this means that sometimes banks run short of their reserve requirements. In order to avoid problems with the Fed, banks often borrow reserves from each other in what's called the federal funds market. Okay, so in other words, the federal funds market is where the banks borrow and lend reserves among themselves, because they're trying to keep it down to a minimum, the reserves, but sometimes they overdo it and they find that they don't have quite enough to meet their requirements. And in order to avoid being fined by the Fed, what they do instead is they go out into the bank, to the other banks, and they borrow, typically for very short periods of time, usually no more than a few days. And so the market where this takes place is the so-called federal funds market. The rate of interest charged by the banks for these reserves, loans of reserves, is known as the federal funds rate. Now, that rate right now is at a preposterously low level. I think it's 0.25%. So let me just double check that. It's about a quarter, yeah, 25. Okay, so the Fed doesn't set this rate. It sets a target for this rate. So right now, the target is 0.25%. Now, let me just mention this here, if the Fed funds rate, let's see, falls below the target, the Fed can reduce or remove reserves from the banking system, and thereby increase the Fed funds rate back to its target level. This is done by selling Treasury securities to the banking system, and the banks pay for these securities with reserves. So if the Fed sells bonds, Treasury securities to the banks, that reduces the amount of reserves in the banking system, and that drives up the Fed funds rate. On the other hand, in the opposite case, let's see. Let me just duplicate this slide and make a few key changes. If the federal funds rate rises above the target, the Fed can increase reserves in the banking system, and thereby decrease the Fed funds rate back to its target level. This is done by buying Treasury securities from the banking system and the Fed pays the banks with reserves. So in other words, this process actually increases reserves in the banking system, and that pushes the Fed funds rate back to its correct level. So the Fed can, anytime it wants to, it can increase or decrease the reserves in circulation, which in turn can affect the Fed funds rate. So that's why this is here then, because those bank reserves actually belong to the banks. So that's defined as a liability for the Fed. And so you can see that the sum of these two also adds up to the monetary base. So we have two ways, equivalent ways of expressing the monetary base. Usually we use the second one. It's just easier to deal with. So we have currency in circulation plus total reserves equals the monetary base. Now the reason why this matters is because the Fed directly controls the monetary base. And so this is what they can use to influence monetary policy or carry out monetary policy. So in fact, just out of curiosity, why don't we take a look and see what the size of the monetary base is at the moment. We're going to look at the special database called FRED. FRED is it stands for Federal Reserve Economic Database. It is run by the St. Louis Fed. And so what we're going to do is see what the monetary base looks like. Let's see. I'm trying to figure out which one I want. No, let's try something else. All right, so if we're looking at it's about just a hair under $5 trillion. That's the size of the US monetary base. Roughly $5 trillion worth of currency plus reserves in the banking system. This is the one that the Fed can change. Now, if you notice, it's sort of jumped up very dramatically in the last several years. Partially, this is in response to the credit crisis in the late 2008, 2009 area, and now, of course, the COVID. Before that, it was pretty stable. And that's how monetary policy was conducted. They would allow the monetary base to grow very slowly over the years so that the monetary base could grow at the rate that they were hoping for. All right, so the monetary base is what the Fed directly controls. They can increase or decrease currency in circulation, and they can also increase, as we've seen, or decrease total bank reserves. So therefore, the Fed can directly control the monetary base. But yes, and so the monetary base has two potential alternative definitions. And so the Fed funds rate is the rate, as I said, that the banks borrow and lend among themselves. And by the way, I think I forgot to mention this up here. If the Fed removes reserves in the banking system or adds them, these two are collectively known changes in reserves in the banking system by the Fed are collectively known as open market operations. When the Fed buys bonds and pays with reserves, this is an open market purchase. When the Fed sells bonds and removes reserves from the banking system, this is referred to as an open market sale. And both of these are collectively known as open market operations. This is an important component of monetary policy because it can potentially happen every single day. It depends on how volatile the Fed funds rate is. All right, now, so there's the monetary base, which the Fed can directly influence. What else do we need to know? So when the Fed increases reserves in the banking system, that has the effect of lowering interest rates. It lowers the Fed, as we've already seen. And when we do the opposite, and by the way, because of that, this is referred to as an example of expansionary monetary policy. All right. Remember the whole idea here, we're trying to expand the size of the economy. And so what we're doing is stimulating the economy with lower interest rates. So this is known as expansionary monetary policy. With an open market sale, we're doing the opposite. We're taking reserves out of the banking system. Interest rates go up, and therefore this is called contractionary monetary policy. In other words, they're slowing down the economy in order to reduce the unemployment rate. Nice. Now, let's tie this together now with the money supply. What do the two things have to do with each other? Well, it turns out the money supply is a multiple of the monetary base. In fact, what we can do is go back, well, actually, before we do that, it turns out that there's basically two different definitions of the money supply that we can use. The first one is called M1, which mainly consists of currency in circulation plus checking deposits. It has a few other small items, but that's basically it. We have other measures. Now, M3, I believe, has been discontinued, but M2 basically includes M1 plus some other types of assets that are not as liquid, such as savings deposits and time deposits. So what we're going to do now, in fact, I think I can find a chart somewhere. The Fed should have one of these, the relationship between M1 and M2. All right, let's see. Oh, this is Fred. This is not what I wanted. Okay, here it is. It's a little small, but you can see it. So M1 is currency and coins too, checking deposits, traveler's checks, which you don't see very much anymore. Over here, M2, we add to that the savings deposits, money market funds, certificates of deposit, and other types of time deposits. Now you can see M1 is quite a bit smaller than M2. Most of the time, when we think about money, the money supply, we're thinking about M1. All right, now the Fed's job is very difficult as far as keeping track of these, what they're called monetary aggregates. The technology, meaning like ATMs and that kind of thing, has made it much more difficult for the Fed to measure M1 and M2, which of course makes their job a little bit more challenging in conducting monetary policy. So let's go back to Fred and see what kind of magnitudes we're looking at here. Remember, we mentioned before that the monetary base is roughly $5 trillion. So let's go back to Fred. Say, Fred, show us what M1 looks like these days. And we're looking at roughly $18 trillion. Okay, well, that seems like a lot of money, doesn't it? $18 trillion. Although it spiked up a lot thanks to COVID, it was down around 3 or 4 trillion. Look at this. This is why people are worried about inflation, by the way. But yeah, the Fed has been trying to pump money into the economy to keep it going during the COVID crisis. Now, how about M2? Now, M2 is clearly bigger than M1. In fact, it's about, it's only slightly higher, $19 trillion. That's still a lot of money. It doesn't seem to have spiked up quite as much as M1, but it's still a big increase. And it's, of course, because of the COVID. All right. So anyway, with all that being said, M1, the money supply, we're going to think of M1 as the money supply from now on. M1 is a multiple of the monetary base. So now, this little m here is what we call the money multiplier. It tells me how many times larger M is, the money supply, than the monetary base. Now, Fred should have this as well. Let's go take a look at it for a second. Okay, Fred, we want to know the M1 money multiplier. Oh, it's been discontinued. Yeah, I think the Fed was saying how it's becoming less and less relevant given the technology with ATMs and depositing checks by email, phone and all this and that. So right now, the multiplier is roughly 1.2 to 1. So in other words, if the monetary base is $10 trillion, then M1 should be about $12 trillion. So this tells me the relationship between the two. I don't know exactly why they discontinued it. In fact, maybe we could find out. Hold on one second. Why was the M1 money multiplier series discontinued? Oh, look at that. It's only been gone for a while. Well, I guess one day, if we spent a lot of time looking for it, I guess we'd find it eventually. I was just kind of wondering why they stopped issuing it. All right, we can find out some other time. All right, here we go. Now, where is this coming from? Well, there's several different models of the money multiplier that we could use. One of them is just to take 1 over the required reserve ratio, which means the percentage of deposits that banks must hold as reserves. All right, so the required reserve ratio, so at the moment, actually during the COVID, the requirements were actually suspended, if you can believe it. At the moment, the banks can literally lend out 100% of their money if they want to, but only because of the COVID. But before the COVID broke out, the size of this required reserve ratio depended on the size of the bank. So, for example, let's go ask Google and say, how is the required reserve ratio determined? There should be a chart somewhere that will let us look at this very quickly. And this is very new. So right there, footnote, during the pandemic of 2020, the Federal Reserve reduced the required reserve requirement to 0, but that's not going to last. They can't leave it like that forever. But here it is. The last time it was updated was January 2019. Banks with more than $124.2 million in net transactions accounts were required to maintain a reserve of 10%. Banks with between 16.3 and 124.2 million were at 3%, and banks under 116.3 million did not have a required reserve ratio or a reserve requirement. But most banks in the United States are in the first category. So for all practical purposes, we can think of it as 10%. And so here's the simple multiplier, as we call it, 1 over the required reserve ratio, so that if it is indeed 10%, then that means the money multiplier would be 10, according to this model. Now, it's hard to say now because we saw that the number was discontinued, but for all practical purposes, you can think of the money multiplier as being the ratio of the reserve required, 1 over the required reserve ratio. All right, now we're going to be developing a couple of graphs here that will come in very handy throughout the rest of the course. We're going to try to analyze how the Fed affects interest rates and the exchange rate through their conduct of monetary policy. In order to do that, we need to introduce some key notation. For example, we're going to introduce this to represent what we call the real money supply. So what is that all about? Well, you might recall that real means adjusted for inflation, at least in this context. So what we're going to do here is see that we're going to let MS by itself represent the nominal money supply, meaning the actual value in today's dollars. And then by dividing by P, this is a price, the price level. The ratio of these two becomes the real money supply. All right, now in economics, we often make a distinction between real and nominal variables. This is no exception. We're going to analyze monetary policy in terms of not the nominal money supply, but the real money supply. Now, we're assuming that the Fed chooses this level, and that will be the actual money supply. It's a simplification, but that's what we're going to assume. Now, the demand for money is a much more challenging thing to analyze because it's ultimately coming down to consumers. So what I think we should do here, since we got a lot done tonight, is maybe we could stop right about here and next time pick it up with a discussion of the demand for money. And then we can develop some very interesting graphs which show us how monetary policy works and how it affects the dollar. Okay, we're going to need to use that over and over again throughout the course. So this is a big, just like the previous chapter, all those graphs were critically important. This is another one, but it's coming from the Fed rather than the financial foreign exchange markets. So, all right, I tell you what, why don't we knock it off right about here? And let's say between now and next week, you should read these slides and we'll carry on from there. All right. How does that sound?
Sounds good. Thank you.
All right. So see you next time.
Thank you.
See you next week.
Right.
Have a good
Okay,
one.
bye.
See you. Have a good night.
See you later.
Professor, I had a question.
Yes. Yes, go ahead.
I was gonna say for because I saw on the syllabus and last week's meeting and stuff, we had chapter problem sets.
Oh yeah, well don't worry, we'll do those. Did I not post them?
No, I didn't. That's why I was just making
Oh,
sure.
all right. I'll tell you what. We do have them.
Okay.
The thing is, I think the first one is chapter 14, and we just finished it tonight.
Yeah. That's what I thought. I was just making sure.
Yes, no, that you did the right thing. So
Okay.
we'll probably think about doing that. Maybe not next week, but the week after.
Okay, yeah, no, that's fine. Because I was just concerned because I thought like I missed something because I was checking.
No, you didn't miss anything. No.
Okay, perfect. No, that's all I wanted to know.
Okay, good.
Thank you, Professor. I see you next
You're welcome. All right, bye.